In today's video, I am going to be sharing with you how to start a forex trading as a beginner in 2024. This video is meant for those that want to become successful in the forex market, but they don't know anything about forex trading. They are pure newbie. They don't know anything about forex trading. So that is why in today's video guide, I'm going to be sharing with you a simple explanation on how the forex trading industry works. So once you watch this video from the beginning to the end, you are going to understand everything about forex trading, and this 2024 is going to be your year of breakthrough. So my candid advice to you guys is to make sure that you watch this video from the beginning to the end, so that you understand everything about forex trading. And like I said, this video is going to be basic. I'm going to take our time to explain everything about forex trading, so that a new person that is entering into the industry, a newbie, a beginner trader, will understand everything about forex trading. So before we start, what is forex? Forex is an exchange of what? Of one currency to another. Now, the definition of forex trading is the exchange of one currency for another to profit from the trade. So when there is an exchange of currency, then forex has taken place. For instance, if someone has the Nigerian naira and then use it to buy the US dollars, that person has done what? That person has transacted business. We call it foreign exchange, right? And if someone exchange euro to dollar, that person has done what? Foreign exchange. So when there is an exchange of one currency to another, that is what I mean by forex. But there are different kinds of forex. We have the traditional forex and we have the online forex trading. So the normal forex is the one we do physically, where you can have your physical money. Like if you are in Nigeria, your Nigerian naira, you can use it to buy the US dollar based on the current worth of the US dollar, based on the exchange price, right? So for instance, if you buy the US dollar, let's say one US dollar right now is 1,600 naira, right? So when you bring 1,600 naira and then buy $1, that is an exchange. You have done a transaction. So you can clearly see that this is the traditional aspect of it. So you can hold on to the dollar, and when the dollar goes into value, like when the dollar goes up to maybe 2,000 Nigerian naira per $1, you can then sell it and gain income. So that one is for the traditional aspect. So that one is different from the online aspect. Like the people that does the traditional aspect of it, they always buy the dollar when it is cheap. Like when dollar was 1,000 naira, $1 was 1,000 naira, many people bought so many dollar and stored it, and now that the dollar has increased to 1,600 naira, they can decide to sell off the dollar because they have made profit. So they were able to buy the dollar when it was cheap, when it was just 1,000 naira per dollar, and right now that it has increased to 1,600 naira per dollar, it has increased, so they cannot sell their dollar at that rate of 1,600, so they have made profit. So that one is for the traditional aspect. But when we come into the online aspect is where traders trade the currency based on quotes, right? They are predicting the movement of the currency. That is what forex traders do. They don't buy the way traditional traders do. They do what? They predict the directional movement of the market, and that is what gives them the profit. So if they can be able to predict that the market will go up in a matter of time, they will make money, right? So if the market goes in that direction, they make money, but if the market goes against them, they lose money. So that is how the online traders trade forex market. So forex is the largest financial industry in the world, where millions of people are trading on a daily basis. So the daily transaction or liquidity of forex is over $6 trillion. So that is to say, in a single day, over $6 trillion is traded every day in the forex. So this makes it the largest financial transaction in the world. So if you begin to calculate the number of people that are trading forex, you will see that there are so many globally. So even the banks, the retailers, the companies, government, everyone is trading forex. As long as there's an exchange of currency, a transaction has already taken place. So that is the basic of forex trading. So for you to become successful in trading, you need to be consistent. So simplicity and consistency is the driving force to success in forex trading. You need to make everything simple and then be consistent with your trading. So like I said, forex trading involves two currency, and the exchange of these two currency means that forex has taken place. So forex involves two currency, and when there's an exchange of those currency, it means you are trading forex, right? So if you are exchanging the dollar for the euro, you are trading forex. If you are exchanging the pounds, the British pounds to the euro, you are trading forex. If you are exchanging the Canadian dollar to the US dollar, you are trading forex. If you are exchanging the US dollar to the Japanese yen, you are trading forex. So once there's an exchange of currency, it means you are trading forex. So forex is the largest financial industry in the world compared to stock. Forex is larger than stock, and the forex market is traded 24 hours every day from Monday to Friday. Forex is traded 24 hours Monday to Friday. Once you open the chart, you see that the market is running Monday to Friday, right? It's only weekends, Saturday and Sunday, that the market close. So the forex market is traded 24 hours, and once you are a trader, you will definitely find an opportunity to trade the market. So there are several sections that you can trade. We have the London section, we have the New York section, we have the Tokyo section, and we have the Sydney section. So once you are trading, you should know the section that fits you based on the currency pair that you are trading. So if you are trading on currency pair that has the Japanese yen, the quote of the Japanese yen, then the Turkey session will be the best time to trade. And if you are trading on a pair that has the USD quote, then the New York session still remains the best time to trade. And if you are trading a pair that has the GBP quote, then the London section is the best for you. And if you are trading the pair that has the AUD quote, then the Sydney section is the best. So you pick the section that fits your pair. So you look for the period, the time when the market is trending, when the market has liquidity, when there is a momentum in the market. So that is why this types of session is available, so that you know when to trade. You don't just hop into the market. You have to plan the time you have to trade. So if you are trading based on the USD quote, then you need to look at the New York session. And if you are trading based on the GBP quote, you need to look at the London session. And if you are trading based on the Japanese yen, you need to trade based on Turkey session. And if you are trading based on the AUD, then you need to look at the Sydney session. So now we are going to look at the quote and the base in forex. So when you you are trading, you normally see that there are two abbreviations of different currencies. For instance, the euro is abbreviated EUR. The United States dollar is abbreviated USD, while the Canadian dollar is abbreviated CAD, right? Then the Japanese yen is abbreviated JPY. So now, for you to understand the base and the code is to look at the first letter and the last one. So if you look here, this is euro and this is the USD. So in this scenario, the euro is the base while the USD is the quote, because the euro comes before the USD. So the euro is the quote and the USD is the base. So you can clearly say that each time you are looking at the market, for the fact that the euro is the base and the USD is the quote, it means that the euro is always higher than the USD. So the value of the euro is always higher than the USD. So if you check, you see that a euro, 1 euro is higher than 1 USD. So the same thing applicable to the GBP USD. So for the fact that the GBP USD it comes first before the USD, it means that the British pounds is higher in value than the US dollar, right? So that is why the British pound comes first before the USD. So this is what I'm talking about. You can clearly see that the GBP comes first before the USD, right? So the GBP is the base while the USD is the quote. The reason is because the GBP has more value than the USD, right? So 1 British pound is higher than 1 US dollar. So that is why the base is the GBP while the quote is the USD, because the GBP has more value than the USD, right? So this is how this was arranged based on the worth of each currency. So had it been the USD is more valuable than the GBP, the USD would have come first before the GBP. But for the fact that the GBP is more valuable than the USD, so that is why we have the GBP as the base while the USD now comes as the quote. Just the same thing with the euro USD. So the euro is the base while the USD is the quote. The reason is because the euro is higher in value than the USD. So 1 euro is more valuable than 1 USD, right? So this is how it is. So the USD card here tells us that the USD is higher than Canadian dollar. So the United States dollar is higher in value than the Canadian dollar. So that is why the USD comes first before the Canadian dollar. So in this scenario, the USD is the base while the Canadian dollar is the quote, because the USD comes first before the Canadian dollar. So this is how this base and quote was measured. So that is why when you open your chart, you will definitely see different pairs and you see the base and the quote. So the first currency is the base while the second currency is the quote. So the reason why it was arranged that way is based on the worth of that currency. So if this currency is higher than this currency in value, then that currency will come first, followed by the lesser currency. So that is why we have the base and the quote. So in this scenario, the USD is the base while the Canadian dollar is the quote, because the USD is higher in value than the Canadian dollar. So the same thing applicable to the USD against the Japanese yen. So the USD against the Japanese yen also means that the USD is more valuable than the Japanese yen. So 1 USD is higher than 1 Japanese yen. So that is why the USD comes first before the Japanese yen. So in this scenario, the USD is the base while the Japanese yen is the quote. So this is it. You can clearly see that the USD comes first before the Japanese yen. So the USD is the base while the Japanese yen is the quote. So this is how they measure this. So if you go to your currency pairs and check through them, you will see that you see the value of what I'm talking about. You see the differences. So the first currency is always more valuable than the second currency based on the worth in the market, right? So that is why you can clearly see that here the USD comes first before the Japanese yen, because the USD has more value than the Japanese yen. So one USD is more valuable than one Japanese yen. So this is how you can be able to understand the base and the quote of a currency. But if you go to future like metal, you can clearly see that we have SAUSD against the USD. So if you go to metal, we have SAUSD against the USD. So it means that the gold is more valuable than the US dollars. So that is why this SAU comes first before the USD. So here you can see that this SAU stands for gold, right? 1 ton of gold, right? So you can clearly see that 1 ton of gold is more valuable than 1 USD, 1 US dollar. So that is why SAU comes first before USD. The reason is because the gold is more valuable than the US dollar. So this SAU stands for 1 ton of gold. Then this USD stands for $1. So 1 ton of gold is higher and more valuable than 1 USD. So that is why the SAU comes before the USD, right? So that is why we have the SAU before we now have the USD. So the same thing applicable to other pair. If you check, we also have the Bitcoin. So if you check here, you see that the BTC comes first before the USD. So this tells you that the BTC has more value. So 1 Bitcoin is more valuable than 1 USD. So that is why the BTC comes before the USD. So this is how you understand the base and the quote of the currency pair that you are trading. Now we are going to look at the major currency and the minor. The major currency pairs are the currency that have the USD quote. So this currency are more traded in the market than any other currency. So they have more liquidity. They are 7 in number. That is why they call them the major currency. So this currency pair has the quote of the USD. That is why they call it the major currency pair. The reason is because the USD is the Federal Reserve, right, of all currency in the world. So if you check everything that is being done all over the world is based on the USD. If you are looking at the richest people in the world, the calculation is based on the USD. So everything that is done is based on USD. That is why USD remains the Federal Reserve, right, the currency that the whole world is using. So anywhere you go to, you can simply and easily exchange the USD, right? You can carry your currency. This country you go to, you won't be able to exchange your currency, right? They won't accept it, right? Like the Nigerian naira now. If you carry the Nigerian naira and go to the US that you want to change it, nobody will look at you, right? But if you bring the USD to Nigeria and you want to change it, people will rush and change it for you, right? So that is why the USD is referred to as the Federal Reserve, which is the currency that the whole world is using. Everybody in the world is using USD. So there's no country in the world that you tell me they are not using USD. So each country you go to, definitely they will have a transaction of the USD. So that is why this major currency has the USD quote. So the major currency are the currency of the country that has more economic power in the world. So if you check the major currency that has the USD quote, they're the country with the strongest economy, right? So we have the British pounds, we have the Australian dollar, we have the United States of America dollar, we have the Canadian dollar, we have the Japanese yen, we have the New Zealand dollar. So let me show you how a major currency pair looks like. So now if you look here, this is what we call the major currency pair. So you can see that they have the USD quote. So the Euro USD, the USD JPY, the GBP USD, the USD CAD, AUD USD, NZD USD, and USD CHF. So there are 1, 2, 3, 4, 5, 6, 7. So these 7 pairs are known as the major currency pair. So why are they called the major currency? They are called the major currency because they have high liquidity. These are the most traded pair all over the world, right? So that is why they are called the major currency pair, right? And if you watch, you see that this currency pair, their country have great strong economy. Like the euro is for European countries, so European countries have strong economy. Then the USD is for the United States of America, and as you know, the USD, the United States of America, has a very strong economy. Then we have the JPY, which is the Japanese yen. You know, the Japanese has strong economy. Then we also have the GBP USD. The GBP is the British pound, so the Great Britain has strong economy. Then we also have the USD CAD, the Canadian dollar. So the Canada has strong economy, right? Then we also have the AUD USD, which is Australia. So the AUD is the currency for Australia. So you can see that the Australian has strong economy. Then the NZD USD is for New Zealand. So you can see that the New Zealand have strong economy. Then the USD CHF. Then the CHF stands for Swiss franc. So the Swiss franc has strong economy. So that is why they are known as the major currency pair, because they are the most traded currency all over the world. They have high liquidity, right? And their spread are always tight. So for beginner traders, I think the major currency pair is what you should focus your attention and your interest in. Focus on the major currency pair because they move slightly well compared to other pairs like the minor or the cross. So the major currency pair has strong liquidity. It's likely that you will be seeing any form of volatility, unnecessary volatility on the major currency pair, and the spreads are very, very tight. So we also have the minor currency pair. So the minor currency pair are the pairs that does not have the USD code, right? So example here, these are examples of the minor currency pair, pairs that doesn't have the USD code. We have the GBP JPY, Euro JPY, GBP AUD, Euro GBP, Euro AUD, CAD JPD, CAD JPY, GBP CAD, Euro CAD, so on and so forth. So all these pairs you can clearly see here, they are the minor pairs because they don't have the USD code, right? So call them the minor pairs. You can clearly see them. So look at them all. They don't have the USD code. You can see the NZD CHF, NZD JPY, CHF JPY, CAD CHF, AUD CHF, and so on and so forth. So this is why we call them the minor pair, because they don't have the USD code along with them. So that is why they're called the minor pair. So this minor pair always trend. They have high volatility in the market. So it's not recommended for newbie traders because there is always volatility in the market. So these minor pair are less traded compared to the major pair. So the minor pair doesn't have much traders compared to the major pair, and that is why there is always fluctuation in the minor pair. There is always volatility, unnecessary volatility in the minor pair. So that is why the major pair, the major currency pair, is the most recommended pair for newbie beginner traders to focus on, because they move extremely well and the spreads are very tight, so they don't spike unnecessarily. So that is why it is always recommended that newbie traders, beginner traders, start with the major currency pair. So if you are looking at the most important one, is the Euro USD. The Euro USD still remains the best because the Euro USD is the most traded pair all over the world with very strong liquidity. So this is the Euro USD. So millions of traders are trading the Euro USD. So that is why the Euro USD is the most traded pair all over the world. So if you go to the pair the currency pair of the Euro USD here, you can see that if you check the pips, you see that the pair is always moving slowly, right? So with this pair, there is absolutely no way you can blow your account unnecessarily. So compare someone that is trading Euro USD with someone that is trading gold, right? Gold is just like a minor pair, right? Because there is no much liquidity on gold, so that is why gold is always spiking. Before you know it, gold will spike up. Before you know, gold will spike down, just go up and come down, right? So I will advise newbie traders to stay away from gold, because gold doesn't have enough liquidity. That is why it's just always going up and coming down. The volatility is too high, right? So if you want a calm market where you can have peace of mind, then the Euro USD is there for you as a beginner trader. Don't go and trade a pair that all the time your heart will be beating. 1 second the market will just travel 100 pips. Before you know it, within 10 minutes the market will travel another 100 pips. So gold is highly volatile. So newbie traders should stop trading gold. If they want to secure their capital, they should focus on the major pair. So the most recommended one is the Euro USD. Then the next one is the GBP USD, right? You can clearly see that the Euro USD has a very tight spread. So if you go, you see that most of brokers, they have tight spread for the Euro USD, like 1 pip or even piplet. So the Euro USD has very tight spread. The same thing applicable to the GBP USD. GBP USD is also one of the most traded currency pair all over the world. So the difference with the Euro and the GBP is that the GBP moves faster than the Euro. So the Euro is crawling like a tortoise, right? But the GBP USD moves faster than the Euro, right? So if you want a pair that is secure but still have some volatility, then the GBP USD is good to go. We also have the USD JPY. The USD JPY is the next pair that I can recommend beginner traders to focus on. So once you're starting as a trader, beginner trader, please focus on the major pair, because that is where you can start making small profits. Forget about the minor pair, forget about gold and other exotic pairs. They are highly volatile, and if you trade those pairs, you are going to lose tons of money. So focus on the major currency pair and forget about metals for now, right? As a newbie trader. Then if you want to trade the forex market, you must register with a broker, right? So we have so many brokers that you can register with. If you go to the watch list here, you can see that there are so many brokers you can register with. We have the FSCM, we have the Rwanda, we have so many brokers you can register with. We have forex.com, we have ICE, so on and so forth. So you can clearly see that there are so many brokers. We have Pepperstone here, we have Pepperstone, we have IC Market, we have 8cap, and so on and so forth. So if you go to the watch list and go to the add symbol, you can be able to find so many forex brokers. Can pick the one you want, but before you do that, you must have to research the forex broker you are using. There is absolutely no way you can trade forex without using a broker. Definitely you must use a broker for you to be able to trade the forex market. So the broker will stand as a middleman, right? So you must trade with a broker, right? So that is where you can trade. So for you to start trading, you have to do a research of the broker that you want to trade with. So like I've shown you here, there are so many brokers to choose from. So what you need to do is to go to trustpilot.com and search the broker you want. Then once you are able to get the broker, you go to Trustpilot and know customers' reactions on that pair. Has the satisfaction that traders want? Because Trustpilot is where you can see reviews of people that are using the broker or traders that are using the broker. So you will see positive and negative. So from there you can now know whether if the broker is okay for you or not. Another thing is you need to test the demo account to know how their spread is, right? To know whether if they have tight spread or if their spread is too wide. So you need to understand that for you to trade and make money profitably, you need a good broker. There are so many scam brokers out there, so that is why you need to research about the broker you are trading. So you can simply go to trustpilot.com. Once the website opens, you can now fill in the name of the broker that you want to trade with, and then you can now see reviews from different traders, right? So if you are okay with the broker, if the reviews that you have read is okay for you, then you can then use the broker. But if the review is not okay for you, they don't have what you want, then you can look for another broker and then research about that broker too. And like I say, the best place you can know more about a broker, to know whether if it's a reliable broker, is Trustpilot. So what makes a broker reliable is broker that has a track record, a good track record, broker that is well regulated by top tier government, right? So the broker you are trading with must have a good track record. It must be regulated by top tier government in the US, United Kingdom, Australia, Canada. So these brokers must be regulated by top tier government in the world. So before you can register with that broker, so as to be 100% sure that your money is secured, right? Not when you deposit money, the money will just disappear. So you must make sure you are trading with a broker that is well regulated, a broker that has a good track record, right? And make sure that you can withdraw. That is why you need to go to Trustpilot to make sure that people are withdrawing their money. Not when you deposit, you can't be able to withdraw. Make sure that people are withdrawing their money. You have seen reviews that people are withdrawing their money. So that is when you can now confidently trade with that broker. But if a scenario where people are unable to withdraw their money, they will deposit but they can't withdraw, then that broker is a no-go area. I won't advise you to open an account with that broker. So do your own due diligence, your own research to get a good broker that has what you want, and then you can start your trading career with that broker. So the forex market is traded 24 hours from morning till night, but I won't advise you to always stay glued to the screen. So I think the best time to start trading is in the morning, right? Like 8 o'clock a.m. when banks are resuming work, right? Then you can trade from morning till evening, like 6 o'clock p.m. So the market is always on from Monday to Friday, the currency pairs, right? So you need to look at the section and the pair that you are trading. Like I said before, if you are trading the USD quotes, you need to look for New York section, because that is where the market will move well. And if you are trading GBP quotes, you need to look at London section. That is when the market moves the most. And if you are trading based on the JPY quote, you need to look for Tokyo section, because that is when the market moves well. And if you are trading based on the AUD quote, then you need to look for the Sydney section. So you look for section that match with the pair that you are trading, but that is where the market moves the most. So you want to be entering the market when there is liquidity in the market, when there is momentum in the market, when the market is going in a perfect direction, so as to know when to place your trade and the direction you are aiming for. So that is why this section is very important for you to trade with. So also in forex, there's what we call bull and bear. You will be hearing most of the time when I talk about bear and the bull, right? So if you watch, you see that this is the bull and this is the bear. So the bull are the buyers, while the bear are the sellers. So whenever you hear bull, know that we are talking about uptrend or buyers, and whenever you hear bear, we are talking about downtrend or sellers. So the bull are buyers, people that are only buying, while the bear are sellers, people that are only selling. So in the market, there are two competition, the bulls and the bear. They are struggling for supremacy. So that is why in the market, there are only two things you are looking for: buy or sell. So that is why I have two colors on your chart. We have the green color and we have the red color. So the green color are the bulls, while the red color are the bears, right? So that is how you differentiate between the bulls and the bear. So if the market is in an uptrend, it means the bulls are in control of the market. They are pushing the market up. But if the market is in a downtrend, that means the bears are in control of the market. They are pushing the price down, right? So that is the difference between the bull and the bear. The bulls are the buyers, while the bears are the sellers. So the color that differentiates them is green and red. Green is for the bull, which is the buyers, while red is for the bear, which is the sellers. So you should be able to understand the differences, so and know the direction you are going. If the bulls are in control of the market, then you are only looking to buy, and if the bears are in control of the market, then you are only looking to sell. So that is why you need to understand the difference between the bull and the bear. Then you also need to understand take profit and stop loss. So when we talk about take profit is where you are expected to do what? To take your profit, right? While stop loss is where you are expected to accept your loss. So that is why take profit and stop loss are very important in the market. So if the market is going in your direction, then you should have a take profit where the market can hit and then you collect your profit. And if the market is going against you, you need to have a stop loss where you can accept your loss. So if the market hits your stop loss, it means you have lost and then you can accept your losses. So if you open your new order, you can clearly see you have what we call the stop loss and then have what we call the take profit. So this column is for the stop loss and this column is for take profit. Then what is volume? Volume is the lot size that you are using, right? So we have different kinds of lot size. So you will now look at your stop loss, your take profit, and your lot size. So before you trade, you must think of your lot size, your stop loss, and your take profit, right? So this will be based on your money management and risk management. So when we talk of the stop loss, like I say, stop loss is the level where if the market hits, it will take you out, and that signifies that you had a loss, right? But take profit is a level when the market hits, it will signify that you are in profit, so you take your profit. So you must have a take profit if the market is going in your direction, and you must have a stop loss if market is going against you. So the stop loss will limit you from losing more, right? While the take profit would take you out with profit before the market reverse against you. Then we have what we call the lot size. So the volume is what we call the lot size. We have different lot size. The lowest is the micro lot size. So the micro lot size has 1000 units. So that is why we have 0.01. That is the micro lot size. Then we have the mini lot size. The mini lot size has 10,000 units. So the mini lot size is 0.10. So the mini lot size is 0.10 because it has 10,000 units. So call it the mini lot size. Then we now have the standard lot size. The standard lot size has 100,000 units. So it's 1.00. So the standard lot size is 1.00, right? So the micro lot size is the smallest lot size. It has 0.01. The mini lot size has 0.10, while the standard lot size has 1.00. So before you place a trade, you should look at your capital to know the lot size that you want to use, whether if you want to use the mini lot size, the standard lot size, or the micro lot size, because this will affect your account, right? So if you are using the standard lot size, you make sure you have enough capital before you can use the standard lot size. Like you have like $10,000 in your capital, you have like $20,000 or $15,000. But if you have small accounts like $1,000, then you can use the mini lot size. But if your account is very small, like $500, $200 as your capital, then the micro lot size, which is the 0.01, should be the lot size you should use, because this will help to prevent you in case if you have series of losses. So you have to take lot size very seriously, because this will determine the outcome of your account. If you are using bigger lot size and you have small capital, it's just a matter of 2 or 3 trades or 4 trades, you will wipe out your account. So very important. So we also have what we call the pending order and market execution. So market execution, if you leave the type to market execution like this, that means if the price reach a level that you want to take trade, if you just place sell, this is sell and this is buy, this is sell and this is buy. So if you just place sell, the market will go immediately, right? And if you want to buy and you place buy, the market will just enter immediately. So we call it market execution. So the market takes you immediately. So once you press buy, it enters, you are in. Once you place sell, it enters, you are in. We call it market execution. But if you want to have a setup that you don't need to enter the market immediately, you have a target of where you want the market to take you in, then you can now go to pending order. So in the pending order, we have what we call the buy limit and the sell limit. We have the buy limit and the sell limit. So the buy limit is when you place a buy limit, if you make the settings, the levels that you want the price to be, so the level that you want the price to be, and then your stop loss, your take profit, then you leave the type to buy limit, and then you place, you click this place, it will just take you to the level that you want to enter. So you enter that level, but the market has not taken you in. So until the price comes to that level, the market will now automatically takes you in. So that one is for buy. Why for sell limit is if you have a target where you want to sell, right, you can simply put the number, the level where the market is, that is the number, and then your stop loss and your take profit, then the tag should be sell limit, and you click place. The market will then wait until the price moves to that level, and once it touches your sell limit, you will enter the market automatically. So that's why I call it sell limit and buy limit. So we're going to talk about commission, spread, ask price, and bid price, right? So we're going to talk about commission, spread, ask price, and bid price. So these are terminologies in the forex market that you need to understand, right? So what is commission? Commission is the amount of money that the brokers charge you each time you place a trade, right? Each time your trade is closed, right? So whenever you place a trade and close that trade, brokers will charge you commission. It's not all brokers that charge commission. Some brokers do. So that is why, like I say, you need to do diligent research about the broker that you want to use. Some brokers charge commission for every trade that you place, while some brokers does not charge commission, right? So commission is the charges that brokers place on every trade that you take. So each trade you take, you must pay a certain amount for that trade. So we call it commission. Then what is a spread? A spread is the gap between the ask price and the bid price. You know that if you open your MT5 Android or MT5 on mobile, you will see that there are two lines. Once you place a trade, you will be in losses before you start before you enter into profit, into green, right? If you place a trade, you must be in losses first before you can now be in profit. So the gap between those two lines is what we call the spread. So if you open your MT4, MT5 on your phone, like this is the desktop version, and I think the desktop is not showing it. This is the desktop version of the MT5. It's not showing it. So where you can see it clearly is on the mobile version of MT5 and MT4. You see that there's two lines, right? There are two lines. One is at the top, one is below. So ask price is at the top while bid price is below, right? Ask price is at the top while bid price is below, right? So the gap between the ask price and the bid price is what we call the spread, right? So this is another money that brokers charge each time you enter a trade. So that is why I always say you should do a diligent research on a broker you want to use to see whether if their spread is tight, if the space is tight, because as the wider the space, the wider your money. The tighter the space, the tighter your money. So if you are trading on a pair that the spread is very wide, that means you are going to pay a huge amount of money for each trade that you enter, right? So you need to make research on brokers to find the ones that have tight spread. But most brokers have tight spread on the major currency pair, like I told you, the Euro USD, GBP USD, USD CAD, USD JPY, AUD USD, and so on and so forth. The spread are always tight. Why? Because there's a lot of liquidity on those pair. So that is why their spread are always tight. But if you are trading off minor pairs, exotic pairs, or metal like gold, you see that the spreads are always wide. The spread are always wide. Why? Because there's no too much liquidity in the market, right? There's no too much liquidity in the market. The market is always volatile, right? So that is why there is a large or a very big gap on the spread of minor pair, exotic pair, and metals, right? So the spread is the money that broker charge you for every trade that you place, right? So the line above is the ask price, while the line below is the bid price. So it depends whether if you're buying. So that is why each time you place a trade, you must be in losses before you cannot start entering into profit. So the reason is because of the ask price and the bid price, right, alongside with the spread. So that is why you need to make diligent research before you can pick a broker that you want, so you can be able to protect your money, because as the brokers are cutting charges from you, that is how your account is going down. So once they charge you for commission, they will still charge you for spread, right? So you see that your money is going. So another one is called swap. So swap is different from commission and spread. Swap is the amount of money that brokers charge you whenever you allow your trade the next day. So if you are a swing trader, then you will be paying swap because you always allow your trade till the next day, right? If you are a position trader, you will definitely be paying for swap, unless you are a scalper or a day trader. So you know that scalpers close their trade within a minute, while day traders close their trade before the end of that day. So these are the people that are exonerated from paying swap fee. So the people that pay swap fee mostly are swing traders that hold onto their trade overnight, right? So once you hold onto your trade overnight or over the weekend, you must pay for swap. So these are another charges that brokers are collecting from traders, right? So we have the spread, we have commission, and we have swap, right? So these are the charges that you have to pay to brokers before you start trading. So you have to understand all this terminology in trading before you can enter into the industry, right? So you must make a due diligent research about the broker so that you don't make mistakes that you will regret. So the last terminology here is what we call pips. A market moves in pips, right? So market moves in pips. So if you watch the market, the forex market, you see that the market is always moving. Sometimes the market is going up, sometimes the market is going down. So the market moves in pips, right? So each time the market goes, it moves in pips. So now the pips is the money that traders are making. So each time the market moves in pips, traders are making money or losing money. So depending on the direction, if you are buying and the market is going down, each time the market moves against you in pips, you are losing money. So that now boils down to the lot size that you are using, right? So the higher the lot size, the higher the money you are losing. So the pips will be the same. Like a market can move 1 pip. Someone that has micro lot size, the smallest lot size, can lose cents, like 10 cents, 5 cents. But someone that has mini lot size can lose $1. But someone that has standard lot size can lose $10, $15. So you cannot see that everything now boils down to the lot size you are using. So each time the market moves in pips, you are losing money, right? So the forex market moves in pips just as human beings moves in step. So as a human being, you move in step. You take the first step, the second step, the third step, and so on and so forth. So the same way the market moves in pips. So each time the market moves, it moves in pips. 1 pips, 2 pips, 3 pips, 4 pips, 5 pips, 10 pips, 20 pips, 100 pips, 1000 pips. So this is how the market moves. And as the market is moving, you are either making money or you are losing money, right? So if the market is moving in pips in your direction, you are making money. So the more the market is moving in pips, the more money you are making. So if the market moves 10 pips, you make, like example, $100. If the market moves 20 pips, you make $200. If the market moves 30 pips, you make $300. But if the market is going against you and the market moves 10 pips, you lose $100. You are losing $100. The market moves 20 pips, you are losing $200, and the market moves 30 pips, you are losing $300. So each time the market is moving, you are losing or you are winning, right? So if the market is in an uptrend, sellers are losing. If the market is in a downtrend, buyers are losing. So you see how it works. So that is what we mean when we talk about pips. So that is why if you are trading forex, or you have been hearing about forex, you'll be hearing pips, 10 pips, 20 pips. So the pips is the steps that the market moves, right? So this is how the pips work, right? So you need to understand this terminology. So when we come into forex trading, there are 2 types of analysis in the market, because before you place a trade, you have to analyze the market before you place a trade. The analysis will help you to know or be able to predict where the market is going to move next. So we have 2 types of analysis. We have the technical analysis and we have the fundamental analysis. So technical analysis use price chart to analyze the market, right? Some technical analysts use indicators to analyze the market. So when we talk of technical analysis, we have the price action traders and we have traders that trade based on indicators. So these 2 forms technical analysis. Like indicators, we have the moving average, we have RSI, we have MACD, we have stochastic oscillator, we have so many of them, Bollinger Band. So these are indicators, but price action traders do not use indicators. They look at the naked price chart and then they use historical data to analyze the price using tools available for them on the market, because brokers have tools like trend line, like horizontal line, like rectangle line. So they use these tools to analyze the naked price chart to be able to predict the next movement of the market. Why indicator traders, they plot indicators and they trade based on what the indicator is telling them. So those 2 forms what we call technical analysis. Then the fundamental analysis are traders who trade based on news. They trade based on current economic news, things that are happening around the world. They trade based on that. They don't trade based on technical analysis, rather they trade based on what is currently happening, right? They trade based on economic news. So we call those people fundamental analysis or fundamental analyst. So these 2 makes up analysis in the market. So you can either be a technical analyst or you can be a fundamental analyst, or you can be both. So these 2 things are very important because they'll help you to be able to predict, right, the next movement of the market or where the market will be heading to. So that is why you need to take our time to understand these 2 for you to be able to trade profitably in the forex market. So these are the basic aspects of forex trading. Once you understand all these things that I've explained in this video, then you now know everything about forex trading. So the next thing, you cannot take into consideration is your trading psychology, your money management, your risk management, your how to control your emotions, how to control yourself, how to avoid being greedy. So this one is a learning process that you keep on learning, right? In trading, learning never ends, right? So in trading, you keep learning. Every day you are learning, right? Even me, I'm also learning. So in trading, learning never stops. You keep learning every day, because each and every day new things are coming out, and new styles, new technical analysis, new things are coming out. So that is why you need to keep learning. So this is all I have for you in today's video. I hope you have found value in this content. I hope you have found a lot of value in this content. Why not smash the subscribe button, give us a like, comment your thoughts and opinion concerning this topic. Don't forget to come back for more updates. Make sure you tune in your notification icon to be the first to be notified whenever I publish new content. I will see you again in my next update. Enjoy the rest of your day. Bye.